Mark Douglas is my favorite trading educator ever. His book, Trading in the Zone, really, I think, made me a profitable trader. He's got a 5.5 hour long seminar on YouTube, which is a lot to take in. So what I'm going to do in this series is break it up into 20-minute segments, make it a little bit more bite-sized, and I'm going to actively take notes that you all can see as we watch too. Kind of make it a group study project, if that makes sense. So hit the like button if you like this idea. Hit the subscribe button if you don't want to miss any of the future videos.
My name is Mark Douglas, and I'm the author of The Disciplined Trader and Trading in the Zone. I've been a trading coach since 1982, and over the years, I've worked with some of the industry's biggest hedge fund and money managers, as well as some of the exchange's largest floor traders.
I'm going to not talk
too much. I know that all of you want to experience consistent results
so.
from your trading. In other words, you want to be able to generate an income you can rely on.
I also haven't ever seen this before. This is my first watch through.
One of the major obstacles in trying to accomplish this objective is in the area of trade execution. To produce a consistent income, a trader has to be able to execute their trades without making any errors or mistakes. In other words, trading without hesitation, reservation, or internal conflict. Basically, all of the errors we are susceptible to are a result of a lack of confidence, or more specifically, trading with fear. What most people don't realize is that trading without fear is actually a learned trading skill, a skill that has to be cultivated and is the primary difference that separates the professional from the typical trader. In this series of DVDs, I'm going to provide you with the kind of insight, understanding, and specific mental techniques you'll need to learn to trade without fear.
110 words a minute, by
the
way.
So that, like the professional, you can move in and out of your trades with the kind of confidence and ease that will allow you to take full advantage of your wise trade or any other trading methodology.
Oh. Go on, Mark. How to Think Like a Professional Trader. That's the name of the seminar. 20 minutes we're going to give kind of each part of this.
Hey, hello. Yeah, good morning. And also, too, how many people came from the West Coast or in the West Coast time zone? Yeah,
the awkward introductions at business
the
seminars.
Wise Trade people picked me up at 6:30 in the morning, which was 4:30
every
in the morning
seminar
for me.
ever.
So when I say that, when I say this, we're here for you, and to ignore the cameras, ignore the environment, I really mean that. But at the same time, I want you guys to help me a little bit, okay? It might take me a little bit, to get going, because I'm not used to doing presentations at 6:30 in the morning my time or 7 o'clock in the morning my time. But anyway, what we're going to do is we're going to go through the process of learning how to think like a professional trader. Why would we want to learn how to think like a professional? Anybody got any ideas? What's that?
Make some money.
Make some money. But you don't have to think like a professional to make money, do you? What does it even imply? What does it imply to think like a professional trader? I mean, let me ask you this. How many you guys have, I don't know what your trading experience has been in terms of the number of years you've been at it, or kind of give me an idea of the demographics here of the audience. I mean, how many people have been trading for more than 2 or 3 years? Most everybody? Then less than 2 years? Kind of new people? Oh, okay. So we've got about half and half. What would it mean to you guys to say, well, let's think like a professional trader?
Then you're not thinking like an amateur.
What's that? Not thinking like an amateur. Okay, that's good. But what are the implications of the difference between a professional and an amateur?
Right, consistency.
Consistency. There you go. You see, you're at my Houston workshop, right? Yeah, consistency. Exactly. In other words, what that would imply is that if I'm a professional trader, in other words, if I've aspired to be a professional, one of the implications would be that I can make consistent money, because if I'm trading in the mode of a professional, I could be a hedge fund manager, a professional hedger working for trading companies, or just having a full-time job as a trader where my income, my sole income, is derived as a trader. And to be in that kind of a position, or to be in a position where other people are going to give you their money or give you their assets to be able to, make money for them, it would certainly imply that you can make consistent money. That there's a way for you to, let's say, create an equity curve that looks, something like this. Is that right?
That is the goal, yes.
Are you going to give your money to somebody with an equity curve that looks like that? I'm not saying that people don't do it, and I'm not saying that it doesn't happen. But I'm saying that if I've aspired to be a professional trader, it means that I must have learned something that's different than the people who can't do this. There must be something about the way that I approach trading that allows me to do that. And believe me, there is. There's a lot. What's that? Cool. Yeah, cool. Basically, and I don't know how many people in the room have either read Trading in the Zone or The Disciplined Trader?
I want to read The Disciplined Trader. I didn't realize he wrote another book. I actually didn't know that.
There's
I want to
actually
read
most
that.
of the people in the group are
Trading in the Zone.
Maybe
Read
even
it.
with me or
Read
my
that
background
book.
at all. True or not? Yes or no? See, no, right? Oh, okay. So I'm going to just give you a little bit, and I'll give you more later on. But I started trading back in 1978, and the first trade that I made, the first trade I made was in potato futures at the Chicago Mercantile Exchange, which they don't even trade potato futures anymore. Why I picked potato futures, I have no idea. I think that's probably what my broker said I should be trading. Maybe he said that there was an opportunity in potato futures, but anyway, I made money. And of course, just like most people who make money, their first trade or their second trade, it's about as easy as one could imagine, and therefore you think to yourself, oh my God, why didn't I learn about this a long time ago?
All of us did that.
That sounds kind of familiar, right? In terms of a thought process. And I went from trading potatoes to trading gold to trading silver. And I'd say my trading experience back then was probably typical even to what it is today with most people, although you have to keep in mind that the technology that we had back then wasn't anything like what you have available to you right now today. It still boggles my mind when I think about the way we had to trade 25 years ago, or almost 30 years ago, compared to what's available right now. I mean, I've always been attracted more to trading commodities than stocks. As a matter of fact, I've never even traded stocks. I've always traded commodities and options. And I've never really had the desire to trade on the floor of the exchange. Although I lived in Chicago for 20 years, it never really appealed to me. I don't know how many people are familiar with the floor or the trading pits, but I just thought it was an extremely harsh environment, and not something that just, like I said, it appealed to me. But the kind of trading platforms that you guys have available to you today really, truly approximate what it would be like to have a seat at the Chicago Board of Trade or Chicago Mercantile Exchange and to trade at that level. You have instantaneous execution. And it's like you can change your mind and not feel humiliated or like there's something wrong with you. You can put it in order. You can cancel it. Back before the advent of electronic trading platforms, we used to have to call a broker. Now you think about the time you made a decision to put on a trade. You think about the time that it takes one to dial the phone, for someone to pick the phone up. How many times it has to ring, and then he gets on the other end of the line. You got your broker, and then you give your broker your order, and then you've got to deal with the fact that does your broker really approve of your order? In other words, what I mean by approve is that, well, see, I want to buy 3 gold contracts, and say, well, some of my biggest customers, they just went short gold. Now what are you going to do with that information, okay? Or I've got, X number of guys that are on the other side of that trade. I say, well, yeah, if you want to take the other side of their trade, that's fine with me. I'll put the order in. So it's like, so he could put the order in, and then, you've got to wait for a fill. I can't tell you how many times that I put orders in the market where they were limit orders because they didn't want to do a market order because I didn't want to get the slippage of a market order. So you do a limit order, and on a limit order, the market has to trade To be guaranteed to fill, the market has to trade through your price, does it not? How many times has the market traded to your price, okay, just right to your price on a buy order and reversed, and you didn't get filled? That's very possible. The problem when you're doing it with a broker over the phone is that order goes into the pit. It goes to an executing broker in the pit itself. So you've got a runner, and the order's got to go back to the runner, back to the phone bank, back to the broker, and the broker calls you with a fill. You're talking several minutes. Now, what if you're in a situation in a fast market where the market actually hit your price? You may have gotten filled, but you really don't know. You don't want to put a stop in the market because you don't even know if you're in or not. And the market's screaming, let's say, even in your favor, and you'd like to take profits, but you still haven't gotten your fill back yet. You don't even know if you're in the market. This is the kind of stuff we had to deal with all the time. All the time. It was a completely different world. Not only that, the only information that we had available to us was
back in my day.
Open, high, low, and close. That was it. Open, high, low, and close bars. And we used to have to get those unless we talked to our broker and pestered them, X number of times a day. You get it through the Wall Street Journal. We used to have to keep our own daily charts. Intraday stuff was just like non-existent. So anyway, I started trading like that. I went through. I don't even remember what my first trading account was. I think it was around $20,000. I lost all of that, and then I saved up some money and opened up another one for around 15. Lost all of that, and then went to another broker. And I'm thinking this guy doesn't know what he's doing, and I'll find somebody who does.
Most people blow their first account. I did.
And then this is what really, this is probably the reason I'm even standing here today. Was this particular trade because this particular trade. It had a profound impact on me in terms of how it changed my life and what I was willing to do to find out what this was all about. To find out really what does it take to be a consistently successful trader? What does it take to really be able to earn an income as a trader? I was long silver. This would have been back in right around 1980 or 1981.
I love how specifically you can remember your best trades.
I was long silver at around $9.75 an ounce.
Specifically, you can remember those.
And there's two 5,000 ounce contracts at the COMEX. In other words, I was long 10,000 ounces of silver at $9.75 an ounce. And right after I got into the market dropped about 20 cents on me to about $9.55. So I was down $2,000. And my broker said, well, okay, here's what we're going to do. Instead of getting out, we'll put you into a spread. And so what we'll do is you're long 10,000 ounces of silver in New York. We'll go short 10,000 ounces of silver in Chicago because you could trade Chicago silver at the Chicago Board of Trade. Everybody with me on this? Just want to make sure that you guys are all with, even though I know many of you are stock traders, the concept is the same, okay? So I'm long 10,000 at 9.75. He puts me short 10,000 at 9.55 in Chicago. So I've got this spread going on. And then he said, well, when the market goes back in your favor, we'll just take the short leg of the spread off. Now, keep in mind, back then, you guys are. What do you typically pay for commissions, even in commodities, or even I don't know what you'd pay for stocks, but typically the average commission is about $4 to $5 a round turn, right? That's what you'd expect to pay. No, what are you paying? Less?
No, more.
More? Round turn? Oh, really?
I got the lowest.
Well, you're in the Dow. You're in the Dow Mini. What are you paying for the Dow Mini?
11.
11.
That's as low as it started at like 30.
Oh, okay. Well, anyway, then 11.
89 back in the day.
Oh, okay. Well, back then, back in the 80s, how much do you think we were paying back then? Come on, give me a guess. Come on. Guess. What?
100.
Yeah, 125. How's 125 a round turn? Yeah. Per contract. Yeah. So in other words, for me to put this trade on cost me $250. Okay. When he put this one on right here, it cost me another $250. And then he said, of course, that when the market goes back into my favor, he'll take the short leg of the spread off, and I should be all right. So that's exactly what the market did. The market went back up to right around the 9.75 area. He took the short leg of the spread off, and then the market immediately dropped back down another 20 cents and put the short leg of the spread back on again. So that's another $250, okay? Plus, he just locked in, when he took this off, first of all, he locked in a $2,000 loss by putting this trade on. When the market went back up to 975 and he took this off, he locked in another $2,000 loss. And then when it went back down again, he put it back on and locked in another $2,000 loss.
Like your broker
now I'm
sucks.
down $6,750. Okay? And then, of course, it happened 2 or 3 more times. Now, from the market's perspective, all the markets, the silver market's just in a trading range. That's all it is. It's just in a trading range. But I didn't know how to read chart patterns at the time and didn't really understand what was going on. I was just listening to him. And so what he was doing is just taking advantage of the fact that it's going back and forth between support and resistance and generating commissions for himself, okay?
That's what I just said.
That's basically, he was just turning my account. But that's not the story, okay? That's happened to a lot of people. Of course, it happens less now because we're all responsible for the trades that we put on. All we have to do is click the mouse button, and it's not that much money. But here's the story: is that as these losses are mounting, okay, and I can't sleep and getting real stressed out. You know, I wake up one morning and I thought, you know what, this is it. I just can't take this anymore. I just can't take it. And so, you know, when I got to work, I called them and I said, you know what, just get out of the whole damn thing. I just can't do this. So just liquidate the position. Does anybody remember the Hunt Brothers silver debacle?
No, I'm not old.
Does anybody, if I say the word limit up, does anybody understand what I mean by that? Okay, the exchanges will impose artificial price limits of how much a commodity, or even a stock for that matter, can fluctuate in any given day before they stop trading. So we don't have these kinds of moves too much anymore, but back in the 80s, limit moves were really quite common. They really were. In other words, what would happen is this: if the market went up, let's say, I think in silver it was 50 cents. I don't remember exactly what it was, but if the market went up by 50 cents, they would actually stop trading. Meaning, if the market was bid up to, let's say, in this case, $10.25, trading would stop. In essence, what this means is that at 10:25. There were no people, there wasn't anybody in the world, this is important for later on. There wasn't one person in the world who was willing to sell silver at 10.25 if it was a limit move. Not one person. And so what happens is that the price will go up seeking to find who will actually sell. So what the exchanges didn't want is there to be this huge fluctuation all in one day. There might have been sellers at 10.26, or there might have been sellers at $11, but you don't know that because the exchange says we're going to stop trading at 10.25.
That's why they
you guys with me on this?
To make sure that there's asks for bids.
So what happened is that I don't think it happened more than maybe
those levels.
half an hour, 45 minutes after I got out. The market was trading right around $9.75 an ounce, where silver went limit up. And went limit up, was 30 days in a row, to $49 an ounce. To $49 an ounce. I was looking now. Think about this. Okay, now think about being in this kind of a winning trade. Now, when we're in a winning trade, the market almost never goes straight up, and it never goes straight down. There are rare occasions, of course, like in this case, when it does. So that when we're in a winning trade, we have to constantly be making decisions about where we're going to take profits, and how much heat we can take with the market coming back against our position to say, well, is this a time to take profits? Or am I going to let it come back a little bit further? Am I going to come back a little bit further against me? Because, well, is this normal retracement, or is this more significant, okay? Is this a little bit of a profit-taking retracement? Is it more significant? Should I get out now? Do we have more left? Are we going to make new highs? You got to be making all these kinds of decisions. And it's very difficult, as we all know, right? See, in this case, I didn't have to be making any decisions because the market went limit up 30 days in a row. Boom, boom.
You can't get out. That's nice.
It was like, go ahead.
Were you out, or were you still?
I was out. I just got out like a half an hour before it happened.
So you were just going, oh my God.
Oh, well, yeah. See, the problem is I couldn't even get back in.
Oh, he was already. Oh, he wasn't
Because there
in
wasn't anybody
anymore.
willing to take the other side of the buy orders.
Oh, that's a good question. I
On a
thought he was
limit
still
move,
in.
you can't get back in.
So his brokerage did liquidate him before that 30-day limit.
So I
move.
sat
That
back
sucks.
and watched in complete agony.
I thought he was making money. In
I
this.
mean,
I thought, like, he
mean
didn't get out yet.
intense agony.
Did you throw up?
I didn't throw up, but you know,
Missing-
it's like maybe I almost did. I don't know. Go ahead.
Missing opportunities feels worse than losing money sometimes.
You said you had 5 contracts?
No, 2.
Two.
Just
Why
2.
don't you just take one off the table, let the other one run for another day?
First of all, Jerry, you're assuming that I knew that this was going to happen.
Right.
No,
That's what
I'm
I was about to
assuming
say,
that getting out all at once takes you out of the play completely.
Jerry, have you ever been in a situation where we really lost a ton of money and you just can't deal with it
People
anymore?
love that shit, man.
Well,
Well,
that's
no,
where I
I've
was
been in
at.
a situation
People
where
love-
I've been down a lot
people
of money.
love-
I didn't lose because that's on paper.
Oh, because it went
Well,
up 300%.
commodities, no.
You
With
should have
stocks,
stayed
you're
in.
right.
Oh,
With
no
stocks,
shit,
it's
man.
technically on paper. When you're in commodities, the
People
money's
love
out of your account.
time
It's
machine
gone.
trading, I
It's
call
gone
that.
at the end of the day. Okay, it's not. This is not paper money. This is real money. Are you with me on this?
Oh,
Yeah,
you
I'm
should have stayed
understanding.
in one
Okay.
contract.
So I wasn't looking
Like,
at.
why? He
at,
didn't know.
I wasn't looking at like I said, paper losses. The money was out of my account, so I had enough. I couldn't take it anymore.
Let's stop it here. We're 20 minutes into the video. Let's recap. I want to recap the notes at the end of each. Not a lot in this one. It's kind of like, his introduction. But we got a little blitz there at the beginning. Trade without hesitation, reservation, or internal conflict. Most errors come from trading with fear. Trading without fear is a learned skill, which I think is really important. And I think that's something that was really talked about in his book that I read. I think we're going to learn more about that in this seminar. And then thinking like a professional equals consistency. So that's part 1. Once again, a lot of introduction, but we're going to continue this series. It'll be posted every day at this time, 10:30 Eastern, an hour after market open. So you guys can watch market open, watch the first hour, trade the first hour. Then maybe if you want to come over and watch these videos, feel free to do so. Once again, hit like if you enjoy, just to show me that this is a good idea. Hit the red subscribe button so you don't miss any future episodes, and you all have a good day.